Good afternoon, everyone. Welcome to our November 2023 monthly market exchange. We thank you for joining us today. This is Jeff Hibbeler, and today I'm joined with Randy Farina. Before we get started, I'd like to remind you to please send in any questions or comments to info@essentialwealth.com. We will address these toward the end of the call. There have been some meaningful market moves in the month since our last call. Equity market has moved higher over the period, and that was a quick reversal after testing roughly 4,100 on the S&P 500 just a little over a week ago. Bond yields have moved somewhat lower since our last call, but not before hitting 5% on the 10-year Treasury a week or two ago. Currently, it's sitting at about 4.6%. These changes in markets have been recalibrations to quite a large amount of fundamental information, particularly in the last week that we've received. So with a lot to discuss, we're going to jump into it. And Randy, good afternoon. Over the last week, we had the Fed decision, quite a number of economic data, a Treasury auction update, and then we're in the midst of earnings season, and wanted to start off with, what drew your attention and all that, and what were your takeaways?
Sure, Jeff. Thanks for having me, or everybody dialing in to listen to us. Sure, a lot to unpack in the last month or week. From the macro perspective, there was the Fed decision, some economic data, including the jobs report, and then some Treasury issuance news, kind of more on the macro front. I'll give a comment on those, but I'll let you, as the fixed income expert, address those. From the equity perspective, it was more of a, forget the rally for the moment, just kind of at a micro level, more company specific. There were a lot of earnings, and still have the tail end of some earnings this week and next, but most of the larger cap influential stocks reported. The Magnificent Seven, call them. Mostly they were on the decent side of earnings, I'd say. Microsoft, Amazon, Google, and Meta, I thought were all good in terms of comping year-over-year growth, margins, capital allocation, outlook. The stocks, I think, might have reacted. Google was down, Meta was down, but the stocks can move after an individual report, more on kind of positioning and other factors that aren't really about the results in the near term or longer term. So sometimes you can get a good earnings report, but the stock sells off, or a bad earnings report and the stock goes up. So we're not trying to, as investment team here at Essential, we're never trying to time the quarter and make decisions on one quarter. But in general, I thought the results were decent from the Magnificent Seven. Tesla was weak, a little bit of the pricing issue hitting them, and a little bit of volume. And, they keep promising the Cyber truck, so that was a little bit negative. Apple was kind of a mix. Everyone expected revenues to be flattish to down, and even into next year. Don't forget, Apple had a plus 30% revenue growth during COVID. And that's going to take a couple of years to burn through in terms of before you get back to year-on-year growth. They do have a lot of potential drivers with content and health and other factors. But, that's something to always bear in mind, that COVID has really impacted a lot of these companies in terms of what is a normal trend growth. It got kind of thrown upside down in that some companies cratered, anything travel related, and now that's bouncing back. And then other things kind of over-earned. Home Depot with their comps up 20% when they're normally 4%. Consumer electronics, everybody that was working at home had to suddenly go out and buy a ton of what they use in the office for now the home. So there was this adjustment factor that we're still going through. And so that is something that, as we're looking through our companies that we own in the various equity portfolios and the quarterly earnings, something that, we have to take into account that it's still a non-normal operating environment in that, you're still kind of anniversarying the COVID impacts. So that's one thing I wanted to talk about. But another thing I wanted to get into in some of the earnings that we're seeing where there's opportunity getting created. So, that's how we're trying to use earnings as well. Companies that we own, what is the impact? Has it changed our thesis? Has it changed any of our inputs to our valuation? And then what does that mean for the risk reward on the stock? But also any stocks that we have on our watch list that have reported earnings. And there's been a couple of industries, healthcare and staples, that have been impacted by that. I'm sure everyone's aware of the Ozempic and Wegovy weight loss drug that, again, this drug has gone from, this owned by Novo Nordisk, but the drug's gone from 0 to 25 billion in a matter of 3 years. So it is at the moment going to be the best-selling drug combination, Ozempic and Wegovy, call them one drug, ever. So that is having a little bit of a ripple effect into some of the healthcare stocks, in that if you're able to eradicate, well, let me rephrase the word, if you're able to reduce obesity, you might have an impact into amount of procedures done, cardiovascular, in a lot of impact into the healthcare, which would be great longer term. Obesity is an issue that can, impact other areas of your health that then require some kind of procedure, some kind of device, some kind of something. And those stocks have sold off significantly on kind of a headline risk of that Novo Nordisk drug, Ozempic, impacting the longer term, what they call a TAM, total addressable market. So a lot of these company stocks have fallen 20 to 25%. And we were interested in, listening to how they navigated around the headline risk that they're under. Remember, there's a lot of noise that happens in the market, and it's not always impactful or game-changing. And so what a lot of these companies were trying to, in the healthcare device sector, were trying to, placate fears in the market that, even if the Wegovy drug, Ozempic drug, is massively successful, which it's been, it's really just going to take down the long-term growth outlooks, maybe a point. So if they were growing 5 to 6, now maybe it's 4 to 5. But again, the market's probably overreacted. So that's an area where we were looking for opportunity. And you may, I think we've done a trade in one of the strategies, but we are going to look to add some of these healthcare names that have sold off. I'm a little hesitant to mention them just in case we're trading over the next week or two. But again, a lot of them have sold off, and that's where we're seeing opportunity. And another area is also staples. Similar impact from, the weight loss drugs. Some of the early indications are that, your appetite for candy, sweetness is depressed. If that's the right word, or decreased. So a lot of these stocks in the staples area have Hershey's, Nestle, have been impacted by this same theme. Beverage companies, you're going to drink less Coke, less Pepsi, less sweetened drinks. And they've all sold off 20 to 25%, or in the, call it 15 to 25%. So again, that's where we're seeing opportunity. So this earnings season, Jeff, to answer a long question or to give a long response, what drew my attention? It's not always just about the 1 week or the 1 month. This has been, part of the narrative in the market for these stocks for the past month or two. So Pete and I and the analysts, Nick and Justin and Ben, were interested to go through the results to see how the companies are trying to discuss this impact, and whether it is more headline risk or more actual impact to the financials and the outlook and the cash flows of these businesses. It's still way too early to say, actually, and a lot of the companies, were mentioning that, and I agree on that in general, because the COVID drugs have only been out for a brief period of time. We don't know what the side effects will be, et cetera, et cetera. So that's where we're seeing opportunities, healthcare and staples, because of the impact that they've had from an exogenous shock to the market from this GLP-1s is what they're called. And then just to follow up a quick, try to wrap this up here. Industrials were another area where there is some industrial weakness going on. The Fed's lag impact from rate rises is filtering through to the industrial companies that we follow, and we definitely are seeing a slowdown there. Now, it's not negative growth, but there's definitely a slowdown there. So, long answer to the earnings question, and then I'll kick it back to you on the macro side, from the Treasury issuance issue that popped up last week, the Fed's decision, and also some of the economic data beating the non-farm payroll. If you could touch on those. For me, they were all kind of okay, in line, expected, not a huge driver near term to the individual companies' cash flows, but they'd have a market reaction. You saw the bounce last week, because now the indication is Fed might be done, economy is slowing, which we're seeing in the earnings, and then the Treasury issue I'll let you touch on. So back to you.
Yeah. I think, I'm glad you mentioned that at the end there about industrials and starting to see some of the flow through of, the Fed's tightening cycle, because I do think, it's been kind of one of our discussion points and kind of thesis is that, the Fed cycle, the Fed tightening, it will work. But due to the nuances coming out of the pandemic and, just kind of a low interest rate environment for a while, and the effects of that on mortgages for individuals and corporate borrowing, et cetera, it might be taking a little longer to filter through. And actually, probably when you really compare it to prior cycles, things aren't lining up too differently than prior cycles, but certainly the rapid pace of initial increases, I think a lot of folks were anticipating it was going to hit quicker than it did, but we are starting to see that start to filter through. And with the events of last week, usually the Fed is the headline event when they make their decision. And like you said, a lot of it was kind of as expected. It really was. Powell, maybe throughout his press conference, he became a little less hawkish than what the statement read. But I think the one thing now that the Fed they added to the statement, and they're leaning on a bit, excuse me, is that higher yields, those are tightening financial conditions. Clearly, again, you see that in the mortgage market, that it's pushed mortgage rates higher. And so they're leaning on that and kind of putting off for now, using that as for their tightening as opposed to another rate hike. So it's interesting. Sometimes when you get past event risk like we had last week, and there were so many things coming, the market may rally on that. We certainly saw it in stocks. We also saw it in bonds, with prices going higher, yields going lower. So it's something that we're really watching with the level of yields, because there gets to be a little bit of a circular point of logic with what the Fed's doing there. But I do think, again, coming back, they want to maintain that restrictive policy, and it is working. It's just taking some time. But you pointed out the Treasury refunding announcement for the upcoming debt auctions, and it's interesting that really was probably more of the headline event than the Fed announcement, which is extremely unusual. And in almost 20 years of doing this, I don't really recall a time that the market was that focused on it. So it was, again, some of it was passage of just that unknown, but Treasury did lower their projections for their funding needs a bit. versus the initial projections they had released. And also in their upcoming debt issuance, the amount of longer term treasuries was a bit less than expected. And in doing that, they're going to use somewhat more short-term debt in financing deficits. Frankly, when you get down to it, the differences were pretty incremental. But certainly, as opposed to an upside surprise that we saw the last quarter, the downside was, kind of soothed markets a bit. And maybe the other somewhat interesting thing too is that the market got a little bit of a view into Treasury Secretary Yellen's her reaction to valuations in the bond market, and deciding to lean a little bit more on T-bill issuance as opposed to longer term bond issuance. Touching really quick on the other data, payrolls, they were a bit softer. Strikes affected them with auto workers, but we are starting to see some gradual cooling in the labor market. Frankly, that's what the Fed is looking for to help bring inflation down, and some gradual loosening would be helpful, and as opposed to they may not have to tighten as much if they can just see some of that gradual slowdown there. But I would say that in normal times, we've come out of a period of very rapid job growth. Certainly a lot of jobs were lost with the pandemic, but we've seen it's been very rapid for a couple of years. And the headline payroll print of 150,000 in normal times, that's pretty still very solid growth. Economists estimate that job growth to keep up with population is around the 100,000 type area per month. So we're still running above that, but nonetheless, we are starting to see a little cooling. Last month was quite a bit stronger than expected. So it's one of those things where we look at the trends, not overreacting to one particular month, but the trends.
Jeff, I would just like to jump in, and we did get a good question about the rails and freight recession that's going on, and this kind of gets into the has the Fed done enough? Are the rates where they should be, and is there potential for this kind of soft landing? And I kind of want to come at it from this point of view that there's still this, I just mentioned it earlier, this post-COVID adjustment still happening. It's almost 4 years now since the first COVID, once we get into the new year, right? 3.5 years at least. And it's still having an impact. So the rails and, the freight is an excellent example of almost this rolling recession narrative that Ed Yardeni, one of the economists that a lot of people read, has put out there, and it does have some weight to it. The rails in the trucking industry, really, remember, rates spiked, freight rates, and that was because there was a shortage of drivers, there was a shortage of capacity, it was just a supply chain bottleneck, and then and even on the shipping side, and then that alleviated. And what happens when that alleviates is that then prices probably, overcorrect on the downside. So you're getting that readjustment back in that sector. And a lot of those stocks that, whether it's trucking or the rails, we have them on our radar. We just haven't found any of the, whether it's the Canadian rails or there's been a merger too, or the US rails, as that attractive yet. Getting there, stocks are off, say, 15-20% over the course of a year, getting there. But again, they still need to work through kind of the goods that spiked, the pricing that spiked, now that's rolling over. So they still might need a little bit more of an adjustment period. Same things on the trucking side. There was a shortage of labor, and then the labor clears, and then the capacity clears, and now there's a pricing issue where pricing is on the downside. So that is this rolling recession. I've seen it repeatedly in the technology sector as well, especially in semiconductors. They're coming through the downturn now for anything handset related, PC related, anything, consumer electronics related is at its bottom now. Same for China demand on handsets. That should start to refresh into 2024. So you have some sectors like travel still high, still revenge travel, a little bit of that, tail end of that. Everybody went to Europe, it seems, this summer, me among them. That is starting to potentially be a weakness in 24, but then you got all the other segments of the economy that are recovering. Even Nike, I never pronounce it correctly. Maybe it's my Bostonian in me, but even Nike and Adidas had inventory issues with everybody bought shoes because they were all working out at home and going to the gym and doing stuff locally. Then they got caught with too much inventory, but now that's working its way through this cycle. So again, you're still, not to harp on COVID because no one wants to hear about it anymore, but that is still impacting the supply chain or the readjustment to normal, both from a demand and a supply standpoint. It's still having a ripple effect, and we're getting closer to the end, but this rolling recession is kind of what's happening, and that certain sectors are getting hurt this year, should recover next year. Sectors doing well this year probably have a bit of a pause next year. Just wanted to make that point about the Fed seemingly has potentially reached the end of its line. The impact has been felt, and now you're in the corrective stage of the excesses. That was kind of what I wanted to lead into for you. Do you think they're done? And if so, maybe one or two more hikes, which is at this point not going to have that much impact, would be my equity guy novice opinion.
I think that it definitely, and we've been saying this since they, hiked in, say, I think their last hike was in July, that they are definitely getting near the end of their hiking cycle. And they may very well have, executed that last hike. It's the data is always very important at this point. It's even more so, and we want them to execute the soft landing. It's very challenging for them to do that. Because everything is so complex, and the ripples, just as you laid out, take months and years to play out. But we're probably going to see a little bit. Inflation's made a lot of really good progress over the last few months. It's probably going to maybe be a little bit harder over the next few months to tick down like it has. It may show that it's a little stickier, but if we continue to see some labor market cooling and some other cooling in data, like some of the manufacturing and service sector surveys, which also came out last week, and those were weaker, that may help to them to see that their policy is working. It's just taking some more time there. So, the other thing that the Fed has going on is that they're continuing to reduce their securities holdings. And that is also kind of tightening policy a bit in the background. It's more of it's a gradual thing, but that does work to take some liquidity out of the system. It's part of the reallocation process of capital, which will flow through over time. So the market is pricing in a small chance of a hike over the next two meetings. I think that's a pretty reasonable thing to look at, and we'll see, does the data continue to be strong like we saw at the end of the third quarter, or does it kind of continue this softening trend? And if it continues a softening trend, then I think it's going to be harder for them to make the case. That'll solidify their case for skipping the last couple meetings, and I would think that they're going to do that. The one quick thing I'll add is that with the Fed keeping the possibility of a hike there, their goals that they want to maintain a restrictive stance for a longer period to get inflation back to their target solidly, and that keeps the markets from quickly, if the markets feel like they're done, they'll quickly look forward to, okay, when are they going to start cutting, and by maintaining the possibility of another hike, it kind of keeps the markets at bay a little bit from that respect.
And Jeff, from an equity guy's perspective, I know the thought is cutting in 2024, a couple of cuts, but I only see the cutting would be, to me, the cutting would be a result of the economy slowed faster than they expected, or there's some, shock, whether it's the re-emergence of the banking issues we had in Q2, Q1 even, although they've seemed to set up a system to deal with that, or something escalates in the Middle East, or even in the Russia-Ukraine war, or even say there's a geopolitical China-Taiwan event. That then, to me, would be when the global markets react negatively, and the Fed then tries to come in and cut rates to just reassure. So again, my only thinking, or one of my thoughts, is that the rate cuts will be for a reason. That, other than that, maybe because the economy used to work at these kind of rates. So I don't know why it needs to be materially lower, 80s and 90s, and even early mid 2000s, 5% risk-free wasn't unheard of. That didn't facilitate the thought that, oh, it's got to cut, it's got to cut, it's got to go lower. So maybe that's, market needs to transition back to that school of thought, or, again, things that we banter around on the investment equity side, just to how to interpret that.
Yeah, I think there's some, arguments that can be made that, with demographics and some other, kind of big, large macro changes that maybe the economic run rate, and thus, Fed policy rates are probably a little lower than in the 90s. It's to be determined. I think that, clearly coming out of the financial crisis, there was a lot of economic damage and financial system damage that necessitated lower rates, and reduced, basically kind of potential growth. We seem to have kind of gotten through that, certainly just an inordinate amount of stimulus following in the pandemic, really got us through it, and got things heated up then, and overheated at that point. So, I think there is still a little bit of a, kind of a overall recalibration of what is the kind of the new normal. And the Fed has their projections for long-term funds rates, and one of the big debates is it too low right now, and they're not sure. I think our hunch is maybe it is a little bit too low, but it's trying, it's over time figuring out these really long-term things, it does take time to determine that. Randy, wanted to jump in just a little bit here on our second topic, and kind of impacts on markets, and from the DC type angle. It's election day. We won't get into elections, but you had mentioned earlier, you talk about tech and some of the effects with tech spend, and one thing, you're focused there on that sector, particularly with, we've been getting, there's been a lot going on with the China relationship, with the regulations, et cetera. And, wanted to kind of kick this off, ask you about some of those regs with semiconductors, and because, that's certainly been gotten a lot of market attention, that sector here this year.
Right. Yep. There's definitely been, the Biden administration, and even going back to the Trump administration, they're trying to limit China's theft of IP, intellectual property. They put in some, you want the market to be competitive. You want global competition to spur innovation. That's fine. You don't want outright theft. And, some of the, Huawei is a significant telecom equipment company in China, but it really, I think, my opinion, just stole Cisco's routing tables software, and that's how they created a business. So you don't want, that's not competition. That's not competing on merits of, brain capacity, brain power, and just doing something better or more creative. So the latest, semiconductors are from a military standpoint, are definitely something that you don't want other countries to have the capability of if you're trying to compete on a military basis. But even just from a innovation standpoint, if you create something that is driven off semiconductors, you don't want, again, it being just patently ripped off. So they put in some of these regulations that are trying to limit China's capacity to develop leading edge semiconductor chips. You have to build the chip before you can, or you have to be able to have the capacity to build the wafer before you can then put the design on it, not to get too deep into the woods. But what they're trying to limit is their ability to get leading edge semiconductor equipment. So companies Lam, Clack, ASML, which is a Netherlands-based company, Tokyo Electron, which is a Japanese-based company. So you have global companies that are trying to follow the US lead. But there's ways around it. Unfortunately, with anything, regulation is only as good as the enforcement of it. So there's this thing called, the way semiconductor wafers are made, it's called the thickness or the size of it is the nanometers, and you're not supposed to ship anything under 17 nanometers. It goes all the way down to 3 nanometers. So the Chinese company just says, oh, I'm going to do it on 17 nanometers. Oh, okay. And they send the equipment over, and they end up making it on the lower, because the company doesn't know what it's going to be made on. So there's, unfortunately, these regulations are almost paper or unenforceable or not too, I don't know what the right approach is, to be honest, Jeff. So there's an increased regulation, which has impacted maybe cost of capital, growth rates on these semiconductor sides. But I don't know how enforceable it is, or if it's the right policy. I'm not in the think tanks, the Brookings Institute, and trying to figure out what the right policy is. That's not my role in the market. My role is to try to, see what the longer term cash flows from an individual company can be, and is the market pricing it right. So we have to, as equity team, look at the regulations, see how they impact their companies, and then make a judgment call. It's not, again, like politics. It's not for me to say who's right or wrong, or if the policy is smart or dumb. It's more, how does it impact the growth rates, the available market, the total addressable market, the competitiveness, and how do I then price that risk into the individual company that I'm following? So it matters, but I don't know if there's anything that in the short term has that much of an impact. It could bear out over the longer term, and that we just have to wait and see, and be ready or flexible to change course, or to make decisions that again, we may have thought something and maybe something else. So we're always trying to figure it out, but it's hard to get a good read on it.
Yeah, well, I was just kind of thinking, that with the CHIPS Act, have you started to see much,
Yeah, and that's an investment
side?
in the infrastructure. So that is different from a regulation. So the regulation was more trying to prevent, the IP. The CHIPS Act, which is smart, it's now trying to, and this is more from spun out of the COVID, having the supply chain tied up in one geography, Taiwan. That's where all the chips are made. And, that's a geopolitical risk. So the CHIPS Act, which is also in Europe, they're having significant investment in fabs in Germany and Italy, Spain. Most countries want some kind of, whether it's for security or just for this, global balanced supply chain, are investing in chips. So that's going to spur investment in the US, which is good. But it's really not adding to the pie, because that investment would have been made it's mostly the global companies, TSMC and Samsung, now investing in the US where they would have invested in Korea and China. So it helps the US and it helps the global supply chain. It probably raises the cost curve because we're not as cheap as those lower cost countries, but it doesn't add really new capacity on these greenfields. But it's good for the market, good for the world to have a diversified supply base, I'd say.
Mm-hmm. Yeah. The other thing wanted to chat about quick, touched on it earlier, certainly with the Treasury announcement with debt issuance, but we have seen yields move higher over the last couple of years, and certainly, and particularly on the Treasury side, how does that? I know we've talked about this a little bit in the past when we're evaluating companies and fundamental valuation. Has that had any effect on how you and the team are looking at equity valuations?
Yeah, sure. So that gets back to this cost of capital, this cost of equity, or what kind of hurdle rate do you put on future cash flows? All businesses have to do it when you're looking at whether to invest or not. And you could say over the last decade, there was much lower cost of capital. So decisions got made that may not have, that maybe shouldn't have been made. Whether it's from the private side funding startups with no hurdle rate because you're just trying to grow revenues and then hopefully spin it into the public market. I think it's a good thing that cost of capital is going up and has gone up. It should help with the quality of companies that end up coming public, or the quality of companies that get formed, and should limit the amount of destructive capital that gets allocated. The COVID companies that, like, again, not to always pick on Carvana, if you've dialed in anytime, this is one of my pet peeves, but those business models of where I'm going to go have a car shipped to my house that I may or may not want. I mean, I guess I have to buy it if I'm looking at Carvana online, but it's just not a car is something that you just don't know what you're buying. We all know this on a used car. You want to see it, drive it. And so to me, that business model is flawed, was always flawed, may not make a lot of money. And that got a lot of funding. And that was because cost of capital, interest rates were zero. And that's just one example. There's Peloton where, buying a $4,000 exercise bike so you can watch somebody else or someone else can tell you and coach you. It's a fine way to train and work out, but is that worth what Peloton's value proposition was? Probably not. Again, and that was because the cost of capital was so low and skewed towards these companies just trying to capture revenue without worrying about turning a profit and then spin it to the public market. And that was the escape of the VCs and the private equity. So I think it's healthy. Cost of capital, a hurdle rate higher is healthy. It should help clean up excess. It should help, I don't want to say police the market because that's not the right word. Just it should help the allocators make better decisions because, that is at the end of the day, a capitalist society is the best, in my opinion, society because it is free to allocate capital where it wants to, where it should be, and it should be allocating it to where it's most productive and to where it makes a difference from a profit perspective, not just trying to spin it into an IPO, collect the money, move on to the next thing, and then whoever bought it on the IPO gets caught, with the shiny object, which no longer shiny. That is a misallocation of capital, and that's part of the capitalists. There will be failures, and that's fine. It's just, again, I think a higher cost to sum it up, not to go into a rant, a higher cost of capital is much better for the market. And I'd throw it at you, isn't having bond yields at 4 to 5, getting back to the old 60-40 portfolio from this point, more of in line with where allocations you'd want, because now finally fixed income assets are attractive. You know, at 1%, they were probably not attractive. Now at 4 to 5, they're definitely attractive from a long-term perspective.
Yeah, I'm glad you brought that up because there's been a number of articles about 60/40 portfolios and and questions that we feel about kind of the demise of the strategy. But it's yeah, what you were inferring there is I agree with that with bond yields at more normal levels. um it's basically it kind of the starting point matters, we'll just say that. And as the Fed normalized policy for 2 years, that was very difficult on the fixed income side of things. And so it makes it much less challenging, I would say. And it's again, the entry point, starting point matters. And the other thing that you see on fixed income, as yields are higher, then and our philosophy with fixed income is kind of be that ballast of the portfolio, that the stability piece. It can act as that buffer in a portfolio and helps to balance out the overall asset allocation. And 60/40 is kind of the headline. Certainly, as we're our advisor team or working with clients on their allocations, it varies on everyone's individual situation and risks, etc. But having that stability piece and having it act like that is one of the important parts of that balanced asset allocation. Unfortunately, with where the Fed took yields to over the last several years, it didn't have that always have that feature in it. So yeah, I echo your sentiments that having them at a more normal level, it was challenging getting there, but it is much it's healthy for the economy and the financial system to have them at a more normal level. And its knock-on effects with the productive allocation of capital. So in the long run, it's a good thing. Okay, at this point, there aren't any further questions. So we're going to go ahead and conclude today's call. We hope that everyone will join us next month on Tuesday, December 5th at 12 p.m. Eastern. Thank you again for joining us today, and we hope that everyone has a great rest of their week.